any kind on Thursday, check it before you come to school. I would try and make that decision as early as I could tomorrow, but might not be able to do it until the evening. An accident like that, she has whiplash and just on a bunch of meds. I have no idea, how she's going to be able to function until her body starts to stiffen up. So we'll kind of see how she's doing. We'll go from there. So just a quick heads up. Again, if you don't hear anything, just come to class and we'll do property management, chapter 18. But I just wanted to throw that out there since I'm just kind of figuring out that might be a possibility. I would say it's less than likely at the moment, but you never know. All right, so moving back to our lease agreements here, mentioned security deposit a little bit. We have some things here we really specifically need to talk about. So we talked about the fact that earnest, it's really, again, it's the same thing as earnest money. It's not consideration. Rent is the consideration. Rent is the value paid for the space. And again, the security deposit is kind of the show of good faith by the tenant that if I fail to do what I'm supposed to do, then you can take this money. So it's for that. And security deposit can secure the payment of rent. It can also secure obligations like moving out by a certain point in time or doing any other kinds of things that the tenant is supposed to do. So that's the basic idea in general. We'll come back in just a minute, I think, and talk about sort of the residential, Illinois law on certain residential kinds of security deposits, because those are things you might get at the state exam you need to be familiar with. But the reality is, of course, that security deposits, even in apartments, aren't as common as they used to be. Because of the requirements to pay interest and to give notice about damages and other kinds of things before withholding security deposits, quite a few major landlords have gotten away with, they don't do security deposits anymore. Too much legislated or regulated hassle. And with commercial and industrial tenancies, security deposits are fairly rare. Let's go back to the example of Walgreens. Now, you have several different types of commercial business enterprises in the United States when it comes to how they view real estate in conjunction with their business. You get companies like Walgreens who say, we're not in the real estate business, so we're just going to rent. They do not own most of their stores. They're they're major tenants. And those leases, by the way, at some of those corner Walgreens could be $300,000, $400,000, $500,000 a year. It's a lot of money they pay to rent those properties. Because they're very high visibility and high traffic prime locations. So with Walgreens owning however many thousands upon thousands of stores, opening maybe hundreds of them every year, how much money do you suppose Walgreens is willing to pay in security deposit? The answer is none. So if you're going to develop one of those buildings and sign up Walgreens with a lease for 20 years, the security deposit you're going to get from them is going to be absolutely zero. Either you trust their national credit, publicly traded balance sheets available, audited statements for everybody to see, financial records, or you don't. Either rent to them or don't rent to them, but you're not going to get a security deposit out of them. There's just no way that stores with hundreds or thousands or tens of thousands of locations are going to cough up security deposits. The amount of cash they would have tied up would be untold and just would be mind-boggling. So the practical reality is that in commercial and industrial tenancies, you oftentimes have little to no security deposit, and if you do, in any tenancy, security deposit ultimately is a drop in the bucket when somebody trashes your place. So if you have a townhouse that you're renting out for the first time, that's your first investment foray, and you want first month's rent, last month's rent, and a month's worth of security deposit, let's see, put up for that amount. If those people destroy the inside of that place, that $1,200 is meaningless because it's going to cost you $10 to fix it. The problem isn't, oh, I got their $1,200 security deposit. The problem is you shouldn't have rented to them in the first place. So rather than having a great big fat security deposit, the best practices kind of look at property management and leasing is to say, let's do a better job of screening the tenants, which I think we'll talk about more later. But that's the idea: is to screen tenants better. Big security deposits don't really solve the problems they're intended to solve. They just kind of become more of a nightmare of paperwork and kind of a headache. So just want to kind of point out what my experience is with the practical reality of this is. Doesn't mean to say if you rent your house out, you shouldn't get a security deposit. it is a show of good faith. Again, it's like earnest money. It's something you can hold somebody's feet to the fire. But if they're going to vacate 6 months in, that's all you're going to get. You're probably not going to get anything else. All right. So again, security deposits basically are there for the landlord's benefit and to help you make some decisions. If in residential property, we're talking specifically about residential in Illinois, if you're going to be in that business as a manager or as an investor or owner, you need to understand these laws. These are different if you go into Chicago, and many other suburbs have their own landlord-tenant laws, like Evanston, for example. So you need to know what the laws are in those specific towns, because the municipal ordinances will only make any sense if they are more strict. If they are harder on the landlord, that's where you will see them. Right? So in Chicago, that's definitely the case. Evanston, that's definitely the case. It's kind of interesting. I looked at a lease for somebody about a year or so ago. They were renting a unit in Evanston, renting a condo in Evanston that was owned by a company that managed properties and owned properties mostly in Chicago. So their entire lease in Evanston talked about Chicago landlord law. And so this person who's a former real estate student of mine, who never became a broker, called me up and asked me a bunch of questions, and I said, first, this is really questions for an attorney. They go, yeah, I know, but I can't afford an attorney for this thing. Does this make any sense? And so I said, well, if it were me, here's what I would do. I would just push back to my landlord and say, do you really want to have a bunch of Chicago law which doesn't apply referenced in the lease, because now you're going to be bound by the worst of that in Evanston. And sure enough, the landlord, when they realized that they had that situation, they thought, oh yeah, maybe we should make some changes. And they just changed a lot of where it said Chicago to Evanston, because Evanston has its own landlord-tenant law. And the property's in Evanston, not in Chicago. It didn't make any sense to be using a Chicago standard when you're outside the city of Chicago, and the city wouldn't be able to enforce it in the first place. So, all right, so anyway, back to the state law, which is all you really need to worry about for your state exam or this course. In the event that you have 5 or more units in a particular development, and it would probably, courts might also construe this to be the case, if you're basically a professional landlord and simply own or control more than 5 units in a close proximity. You can only withhold security deposit. Well, the theory goes, or the law states, if you're going to withhold security deposit, within 30 days of the time you withhold that security deposit, you must give the tenant, your former tenant, a statement that lists what the damages were. And within 45 days of the total, and within 30 days of this, so if you do this within a day, you don't get the full 45 days, you only get 31 total. So but you have to have either provide them with the list, or you got to return the security deposit. And if you fail to do this, and you don't supply them with the list and eventually the receipts, I don't know what it is, excuse me, list the damages within 30 days and provide the receipts within another 30 days, and in total you only have 45. You have to do that. If you don't, you still owe the tenant their security deposit back, only now you owe them double their security deposit, and they still have the right to sue you for damages. If you're going to become a professional landlord, these are a couple of things that you have to be aware of. How do you get around that? Don't hold a security deposit. That's one of the reasons why some major property investors are saying, forget it, I'm not going to do it. If you have 25 or more units in a development or contiguous, so here's a case where the law specifically states if their units are, properties are adjoining, then you have to pay interest on the security deposit. This interest has to be paid annually if the people stay, or at the end of the term of their lease, so long as they're there at least 6 months. And the interest rate is determined by the state comptroller based upon the state passbook savings rate of Illinois' largest commercial bank, and that's posted on the comptroller's site on December 31st every year. So if you want to know what the rate is now, which is practically nothing, you would go to the site of the Illinois comptroller and it would list the rate as of December 31st, 2014, and that's the rate statewide for the entire year. And it'll change again for 2016 at the end of 2015. How do you get away from this? Have less than 25 units or don't hold a security deposit. So many landlords, instead of security deposits today, will assess like a mandatory cleaning fee or a mandatory move-out inspection fee of $200 or $300 or whatever. Things that everybody has to pay, and that sort of thing. But That's how that works. So again, you could get tested on those kinds of things if you end up going to the state exam. And I guess I might have a question on the final about these kinds of things about security deposits as well. It's a possibility. I'm not a big fan of security deposits. They're a false, they give you a false sense of security as a manager or as an owner, I think. Screen well and the security deposit's kind of meaningless. Questions about this at all? Improvements comes back a little bit to what we talked about with construction earlier. The textbook basically says that improvements, aren't necessarily required. Just think about this for a minute and go back and say, well, improvements kind of depend upon what we're talking about. So with apartments, the improvements are already there, right? We don't rebuild out, we don't reconstruct an apartment every time somebody moves out typically. If there was significant damage, that'll get repaired, but we're not moving walls and making major changes unless we're talking about somebody with a disability, and we'll talk about that in a few weeks when we get into chapter 21 on fair housing stuff. But for the most part, the improvements are already there. Now, when you're talking about commercial and industrial space, improvements can be very little. Like in industrial real estate, there oftentimes isn't much. You need an office. Maybe you need, some other kind of accommodation, but the building either works for you or it doesn't. It either has the column spacing and the clear heights that you need. It either has the overhead dock door sizes and that kind of thing that you need, or it doesn't. And there's usually not a lot of sort of build out unless somebody wants a lot more office space inside their industrial facility. We have more employees, you need a bigger kitchen, you need a bigger break room, that kind of thing. But compared to the size of the lease, it's relatively insignificant. But when you get into offices, which are oftentimes customized, particularly things like medical office suites, which have a lot of medical gases and other kinds of things, where you get into retail, where every use is unique or different, then the build out is huge. And that gets back to what I was talking about earlier with construction. Who's doing what? All that stuff needs to be clearly spelled out before anybody proceeds to do anything. Nobody should ever expect anybody to move forward with build outs or with tenant improvements until a lease is fully signed, clarifying who's responsible for everything. There are a number of legal cases that I've read over the years where landlord proceeds because they believe the tenant is going to lease. You start customizing the space and the tenant never signs because something changes. And the landlord sues them because they say, well, we had an implied contract. Just don't ever do anything until everything is inked in writing or somebody has committed to spend a certain amount of money or take responsibility for something. Accessibility, which is part of working with people with disabilities or other kinds of needs, which again we'll talk about more in the Fair Housing chapter in 21, shows up under several statutes. And this is important, and these kinds of improvements may need to be done or may need to be made, but it kind of depends upon the scenario. If you are going to go in, for example, and renovate a current property that may not otherwise be up to code, you'll be required to bring it up just to meet all of these statutes that apply. So if it's residential, then fair housing will apply, ADA will apply, Illinois Human Rights Act here will apply. If it's non-residential, then maybe just ADA applies, and it depends upon what you're looking at. If you purchase a property and you aren't going to modify it, then none of these things may need to be done to the property, unless you have a tenant for whom you must provide some kind of reasonable accommodation. And again, we'll look at that in more detail a few chapters down the road from here. Yeah, I just don't want you to get the impression that improvements are a meaningless thing you don't have to think about. It all depends upon what kind of property you're talking about. All right, so within the lease agreements, who's responsible for doing maintenance work also matters, right? I mean, that matters significantly and should be addressed inside the lease contract or language or whatever. Particularly under residential here, this implied warranty of habitability is a huge deal. This exists in all states. It's really a common law principle that basically states, look, if you're in the business of leasing residential property for people to live, it is implied in that offer to lease that the space is habitable, that there's adequate heat, that it's not rodent infested, and whatever else this might mean, since it's not statutory and is in fact common law, so it's left for courts to sort of decide where the boundaries of this thing begin and end. But if the landlord fails to provide that adequate heat or fails to otherwise make the property habitable, then they're in breach of their contract, and you've got a breach, and the tenant has a number of remedies they can seek out in that case.
Textbook refers to provide access to.
Yeah.
I had trouble getting a renter out one time and shut off their water because I was responsible for the bill. The piping was still there, they could have turned on anytime they wanted in their name. Was I in violation by turning off their water?
Yeah, it's really frustrating if you're a landlord in some cases. I think real estate law, for the most part, is pretty even-handed. But in the case of tenant-landlord law, landlord-tenant law, it will oftentimes err on the side of protecting a lousy tenant over a good landlord. And that's because of the years of bad landlords making things too difficult on the average people. So these laws absolutely put more pressure on us as landlords or as property managers, because even if you have a tenant who ultimately gets evicted or shouldn't be there or whatever, you cannot lock them out, you cannot turn off basic services, etc. Just think about the law where like People's Gas and Nicor can't turn off the gas no matter how much you owe during certain times of year to residential property. There's that, it would be sort of against public policy to allow people to freeze to death or go without sanitary facilities, even if they're living in a space that ultimately they shouldn't have been in at that time anyway. So it's a really kind of an unfair burden, but it's a burden that the law requires us to bear. So yes, I would, if I wasn't so lazy, I would walk over there and slap you right now. But, and actually in part because I've probably done things that are relatively similar, but we won't talk about those. Because it's frustrating, right? You just want to get them out, and you don't want to keep paying for something that you feel like you shouldn't be paying for. And maybe you're technically right, but legally you don't get that same issue. So again, this comes up, I think, a couple of times in the text here, but the tenant, if the landlord violates this warranty of habitability, the tenant has several remedies, including just move out. Hey, it's cold in this place, and you won't turn up the heat, or you won't fix the problem, or whatever, I'm gone. You know, if we tell the landlord, the water supply is inadequate, we can't take showers, we can't flush the toilet, whatever, just move out. Or you can stay, make the repairs, particularly if they're negligible, and just subtract them from the rent. This is one of the easier things to do. The landlord really doesn't have much objection, so long as the tenant's done a good job of documenting things. This is where email is better than phone calls. This is where a formal letter, or even if it's hand-delivered over to the management office that you have a copy of and ask them to sign for, is better than a phone call. Or you've got some kind of paper trail showing you constantly ask them to do this kind of stuff. You can't just ask once and then leave. You've got to ask repeatedly. Or ultimately, you could file for damage, sue for damages for the breach of contract if you can prove damages for whatever that might be. So again, there are remedies available for residential tenants. Some of these remedies, like kind of an implied warranty of habitability, might transfer through for like an office space, for example. If you're in an office building that's constantly moldy, maybe not an office building, maybe your office space is in the basement, and basements tend to be damp, and it's moldy down there. And you're constantly calling the landlord and asking them to come out and get rid of the mold, that might end up turning out to be something for which you could declare constructive eviction and move out. So there's a little bit of that possibility in non-residential properties, but that's a possibility. Mostly it's going to be residential. All right. It's important to know in terms of the lease who's responsible if the property is destroyed. Does rent continue? It kind of depends. In most scenarios, it's the landlord's property, and if it burns down, the obligation to pay rent stops. But that's not always the case. So you can have, for example, a lease where the tenant is responsible for all of the obligations of the property, including doing all maintenance and capital improvement repair. So let's say that I own a 500,000 square foot warehouse around here somewhere, and somebody comes along and wants to lease it for 30 years. I want to retain it, and I don't want to sell it, but I want to give them all of the obligations of ownership. I could do that if they will agree. You replace the heating and air conditioning equipment up on the roof when it goes out. You replace the roof when you think it needs to be bad. Parking lot's worn out, you replace it. We could have that kind of an agreement in a lease like that. In such a scenario, if that property burns down, it might also be in the language in the lease that states that the tenant is obligated to continue to pay rent and to rebuild the property. So again, this is rare, but it does happen in single tenant, big box sort of industrial or maybe retail leases where you have a standalone 30,000 square foot, 50,000 square foot store, or some big box retailer like a Best Buy or Home Depot or somebody like that. It might make sense in those kinds of scenarios. Leases can be assigned and sublet. Again, when we talked about this earlier, this was the disposition idea we came to, what rights does the tenant have. So the tenant has full right to assign and sublease if the lease does not prohibit that. So normally what you see in residential leases is that a tenant is not permitted to do either. Think about yourself being a landlord. Would you want the average tenant in your building to have the right to just decide who their replacement tenant is? Hey buddy, I can't pay the rent. I know you're homeless, you need a place, you take on the responsibility. I don't think you want average landlord, the average landlord's gonna want the typical tenant to have that right. So in residential properties, rights to assign and sublease are usually completely prohibited. In other sorts of leases, commercial and industrial, you'll usually see some language to the extent that'll say something like, landlord shall not unreasonably withhold the tenant's right to assign or to sublease, which for me means that if the replacement tenant has at least as good a credit or better, on what basis do I not want them in my property? If I would rent to them, why wouldn't I let the other tenant out? And you don't necessarily have to let them out. You could say, fine, we'll take the new tenant, but you're still going to be on the hook, which is a major difference between an assignment and a sublease. Right? I mean, so, kind of depends upon what could be negotiated in that scenario. And again, another reason for attorney involvement when the lease is drafted in the first place. What happens if I'm so busy in my, my mortgage brokerage business is going great guns and I need more space, and the landlord can't provide me, new space. If I'm renting an office and there is no adjacent space or there is no bigger space in the building, I need to get out and grow my business. How do I do that if I can't assign or sublease? These kinds of things matter a lot to a tenant, right? So that's the basic idea. So an assignment is usually the full leasehold interest, right, and all the terms go along with it. And the new tenant is then primarily responsible for everything. That's the basic idea. It's both an assignment and a delegation, really. Here's all my rights and responsibilities under the lease. New tenant, you're now it. And all the rents and the relationship between the new tenant and the landlord would go, and the old tenant hopefully just gets out, goes and conducts their business somewhere else. A sublease, sometimes referred to as kind of a sandwich lease, is a completely different arrangement. Here's a case where it's only a partial transfer of lease rights. It's not the full area, it's not for the full time, and this, basically the original tenant remains fully obligated for their leasehold duties, paying the rent, whatever else they're obligated to do. And so the new subtenant pays rent to the original tenant, who is still obligated to pay to the landlord. So if I sublease my office space, part of it for part of the time or whatever, if I sublease that to somebody else, they're going to pay the rent to me, and I'm going to pay the rent to the landlord. And if they don't pay it to me, I'm still obligated to pay it to the landlord. Hence the term sandwich lease. I'm now kind of stuck in the middle, but maybe that's better than having to vacate to go somewhere else and not having a replacement tenant. Subleasing is a big part of some markets. This is very, very common, for example, in long-term downtown Chicago office market leases, in which some cases those tenant spaces are 100, 150, 250, 300,000 square feet. To give you an example, the building you're sitting in, including the event room, here is about 55,000 square feet, I believe. So take 4 of these, 4 APC buildings all together on a series of floors in a high-rise. You're operating a law firm or a processing center for a credit card company or a bank, and you need to grow or you need to shrink. Yeah, you signed a 10-year deal or a 20-year deal, but you need to move next year, sooner rather than later. What are you going to do? You're going to hope to be able to sublease or assign. And again, these are not small mom and pop tenants. We're talking about major law firms or the Bank of America or United Airlines, people like, entities like that that are well known and very creditworthy. They need to have some rights to be able to move out when market conditions change. And I think this is a bigger issue all the time because market conditions are harder to predict all the time. It's hard to figure out whether your company is going to grow or shrink, or what's happening. So having these privileges from a tenant standpoint is very important. All right, so that's the difference between assignment and sublease. Again, assignment, hopefully, from the tenant's perspective, the original tenant gets to just walk and the new tenant takes on the whole responsibility. Sublease, that's not the case. The original tenant stays in place and is still primarily liable under that original, in fact, they're completely liable under that original lease. Leases can be recorded, or just a memorandum of that lease, just basic details is more common. I've never recorded a lease, but some people insist on it. It gives notice to the world of your leasehold interest. It's a way to establish priority. Something you will not be tested on, but I want you to be aware of this because this also helps to go back and cement some things from chapter 10 that you weren't ready to hear. SNDA. Subordination, non-disturbance, and attornment. These are three concepts that all kind of get woven together in one idea that are typical in commercial and industrial leases or as a separate document. All right, so but they're part of the thing, and neither party, tenant or landlord, can probably avoid them because they have to be there for reasons I'll explain momentarily. Subordinate, to be beneath, right? To kind of establish this priority. Remember we talked about subordination agreements between lenders that could change the priority of who's in which position when we were talking about chapter 10. So under the subordination provision, the tenant agrees that they are going to be subordinated to what or to who? The lender, to the mortgage lender. This is a concern of major lenders. They don't want to take over a property when an investor defaults on the loan. And remember, we talked about investment properties, maybe having special servicers, maybe being able to get defaulted on and possessed quicker than residential properties. You could avoid judicial foreclosure when it's non-residential property in Illinois. So this may happen fairly quickly, and that lender does not want to take over that property and then find they have a priority issue with tenants who've been there for 20 years. First in time, first in right. Who's first? Well, the tenant's going to say, leave me the hell alone. I've been paying my rent. I'm a good tenant. I come first because I've been here a lot longer than since your lien was recorded against the property. And I have a memorandum of lease that was recorded in 1994. So leave me alone. I'm in first place here when it comes to my space and my rights. The bank needs to know that they're going to have full landlord rights when they take that property over. So they want to make it real clear that the mortgage lien takes priority over any of the leasehold interests, regardless of how they've been placed in the public record. The non-disturbance part of it runs to the tenant who says, fine, you want that, that's fine, but we want you to leave us alone. When you take over the property, if we're not in breach, if we're in good standing, all of our rights remain in place. You can't throw us out just because you come in and you go, oh, if I could get rid of these guys and their super low rent, we could make the building cash flow. Because the previous owner could have done the same thing, except they can't by right because our lease prohibits that, right? So I've got this great long-term lease that's way below market, and it's got 5 more years to go or whatever. I want to protect that. So the non-disturbance is you will not disturb us. This is quiet enjoyment kind of stuff. You'll leave us alone, right? And it remains in force so long as we don't breach or go into default. Attornment goes back again into lender protection and just basically says, okay, the lease remains in force upon change in control, because now when the lender's saying it, they want to make sure that the tenant is obligated to stay, right? Under non-disturbance, the tenant's saying, we want you to leave us alone because we want to stay, and the bank's fine, but we also want you to stay. So it's this kind of balancing act of the rights between the parties. And today, you can't get a mortgage loan on a significant investment property without SNDA agreements between you and your tenants, or SNDA provisions within the leases that they have already signed. The bank simply won't underwrite the mortgage if they're not there, at least for the major tenants. It goes back to what we talked about a week ago with chapter 15. The banks are always doing what? They're looking at what if. What if we take this property back? So in this case, the lender's saying, what if we take this commercial or industrial investment property back? We want to make sure that we're in a decent position in relationship to the leases, and the tenants are saying that's fine because we also want to make sure that our lease in fact runs with the land. So long as we're not in default, you're going to leave us alone. So that's the basic idea of SNDA clauses or provisions. And it's something that's pretty important for you to understand it's there, even though I don't think there's anything really in the text about it to any extent, and you probably don't see this at the state exam or on my final. That's what you get for taking a class from somebody who deals with all this stuff. You also will probably not be taught, not have to know about or deal with estoppel certificates for the course or for the state exam. But again, this is really important. And some of this stuff as much relates to property management that comes up in the next class as it does to leasing, but leasing and property management kind of go hand in hand. So an estoppel certificate basically is the statement from the tenant that acknowledges that they are in agreement with the landlord's position on the state of the lease. So if you're going to come in and purchase a property, or if a lender wants to finance the property, they want to know that the tenants agree that the building is properly managed, that there's no breach of the lease by the current landlord. Because if the current landlord is in breach and somebody buys the property or a new lender finances it, and then that tenant decides to move out, the new owner or the new lender can't do anything to stop them because the previous landlord was in breach. So the tenant has the right to mitigate. So an estoppel certificate is a sworn statement basically from the tenant, a page or two in length, that states, yep, everything is good. And absent the tenant providing an estoppel certificate, sometimes lenders or buyers will allow the current building owner to sign an estoppel certificate, knowing that if later that tenant moves out or claims, that the landlord was in breach, the landlord would now potentially be guilty of either bank fraud or fraud in conjunction with the sale. And fraud allows you to just, gets rid of the short-term statute of limitations and gives you much wider latitude to pursue somebody under a great many different and stronger remedies. All right, so you should know that this idea of what an estoppel certificate is, just again, if you get into property management and leasing at all, outside of apartments, it's worth knowing. All right, options. This is back to the state exam material and possible final exam material in this class. And again, good to know for practice if you're in this space. An option, remember option contracts in chapter 11, was in a whole contract where we had the option E, option or. Here the option runs to the benefit of the tenant, always. Options are always for the benefit of the tenant. Two different types of options. One is the lease, to extend or renew the lease for some particular predetermined amount of time, maybe with a predetermined amount of rent, or the right to purchase the property, basically. Kind of a right of first refusal or a purchase option. Technically, those are slightly different things, but you get the basic idea. So, for example, the state of Illinois has a rule that if they're the sole tenant in a building, they must have in their lease the right to purchase the property. Where they would ever come up with the money to do so, God only knows. But if you lease the state of Illinois a barn, they have the right to buy it if they're the only tenant in that barn. It has to be in the lease, or by their own rule, they may not enter into that lease agreement. Lease renewal or extension, again, this is a fairly common thing in retail and in some cases in office or in industrial. Once a tenant who's got an ongoing business operation gets established in a location, that matters, right? So you lease a small space to run your insurance agency out of, and people start coming there to get quotes, to pay their insurance premiums, to get advice on different kinds of policies, to talk about things. When you just aren't there one day, now they're like, wait, where do I go? That matters, and it costs money to move. So when you have an operation that's ongoing and part of your brand is your location, your bricks and mortar location, you may not ever want to leave that space. Well, once a landlord knows that that's where you want to be and business is brisk and you may never want to leave, what's the landlord going to try and do? Charge you more rent, right? Because there's a greater demand, even if it's a demand of one, just your business. So in order to try and avoid that if possible, it makes sense to negotiate in lease options, renewal or extension options, to say, okay, I'll lease for 5 years or 10 years, and I want the option to renew. Maybe you have multiple renewal options. So one building that I managed years ago, for example, had kind of the equivalent of a 7-Eleven in it. Today it might actually be a 7-Eleven. It wasn't when we initially signed them up. Where they took out, initial lease was 10 years and they had 3 5-year options with the rent amounts all predetermined. And those rent amounts turned out to be way above market rent. But that particular business didn't care because they were doing very well at their location. They had enough business, even though everybody else in that stupid little center was struggling or went out of business, they made good money. And they didn't want to leave, and they kept exercising their options. So it made sense for them to do that. And if they looked at it and they weren't doing as well, and it came time to exercise the option, they could just say, no, we're not gonna stay at that rent, which would force the landlord to decide, do we wanna negotiate something at a lower rent, right? I mean, so, again, options always run to the tenant. They really don't do much for the landlord except for make you think you have something that you don't necessarily. It sounds better. Yeah, not only did they sign a 10-year lease, but they have 3 5-year options, which they can walk away from as if they never existed, but you don't bother to remind the bank of that, or remind the appraiser of that, or remind the buyer of that. So those options can sound like they have value to the current building owner, again, that they really run to the benefit of tenants. All right, gross lease, net lease. Again, important to know the difference for test purposes, for practice purposes. Best example of a gross lease is an apartment or a house. You write one check for rent every month, and that covers everything you owe to the landlord. You might also be paying utilities of whatever sorts, heat, water, sanitary, electric, gas, I should say, water, electric, and sanitary. But you just pay one check and it covers whatever for the landlord. You don't also have to write the landlord a check for his property taxes. You don't also have to pay, certain other kinds of things to the landlord. Gross leases are also common for government agencies, which I lease to quite a bit. And government agencies end up with gross leases because they make intelligence statements when you're negotiating a lease that say things like property taxes. Why would we pay property taxes? We're tax exempt, we don't pay property taxes. Fine. And here's your base rent, which, by the way, includes property taxes. Because I have to pay them as a landlord, so you're going to have to pay them as part of the rent. So under a gross lease scenario, all of the income stream that the landlord can expect from the tenant is called rent. That's it. All you get is rent. There isn't anything else. Other expenses on behalf of the tenant, maybe the tenant's obligated to mow the lawn. Maybe the tenant's obligated to fix the roof or plow the snow. But those aren't costs necessarily part of the lease, and they're not being passed on by the landlord. Whereas under a net lease arrangement, which is extremely common with commercial and industrial type properties, the tenant not only pays rent, but they also pay operating expenses, common area maintenance, real estate taxes, insurance costs, and whatever else you can come up with. Very common. So CAM, for example, might include things like maintaining the elevator if you're in a mid or high-rise building that has one. Who owns the elevator? Well, none of the tenants, right? But they all have to use it or get benefit from it. What about the dumpsters that are shared? In a retail building, the maintenance of the air conditioning and heating equipment, which is on the roof right above the tenant spaces, might belong to the tenants, because you can identify which rooftop unit goes with which space. But if you're in a 10-story office building where everybody's sharing the use of the same heating and cooling equipment that's up on the roof, or out in chillers, out in some other space next to the building, the only way to do that is to sort of spread the cost across all tenants. And the way you do that is you have an agreed base rent, and then there's some dollar amount per square foot that's billed to each tenant that they pay monthly, called CAM, that covers all those common area maintenance. Clean, window washing and other sorts of things. Dumpster costs I mentioned, parking lot maintenance. Every few years you got to restripe the parking lot. Who's paying for that? We say, well, that should come out of the landlord's money. Well, it does after the landlord charges the tenant the CAM that goes along with it. Because remember, that space isn't really the landlord's anymore, especially in a retail building. Who gets the benefit of the space? The tenant does. So if the tenant likes it and is going to operate their business there, why shouldn't they be paying some of the building's operating expenses? And if as a tenant you say, well, I don't want to do that, fine, then pay a higher rent and call it a gross lease. Because the landlord's got to collect the same amount of money, however you want to carve this up. Real estate taxes and CAM are the most common pass-through expenses. Sometimes CAM will include things like insurance, property management fees, all kinds of other things. Again, it varies by building to building, and it's much more complex than we can get into in a kind of a brief couple of class sessions here. But you could have an entire course on nothing but leasing and property management. So it's, that should kind of suffice for now. But what CAM charges are will vary from one building to the next. Even what items that are included will vary, because some buildings have different mechanical issues that go along with it. The term triple net, that's the NNN down at the bottom. I wouldn't worry about fully understanding sort of triple net versus net lease or whatever. even within the industry, what triple net means exactly will vary. Office triple net might be different from industrial triple net, for example. I talk to brokers all the time, and they'll say things like, yes, well, this is a modified gross. And I think in my head, I go, what the hell is that? So then I just ask them, what the hell is that? And then they'll tell me, okay, so that's what that means for you. So talk to another broker, and they might describe the same thing as being something else entirely. So I wouldn't get too hung up on what's triple net, double net, what does that kind of mean. Basically, the idea of net, net, net means you're passing through three sets of costs. You know, here's the rent, but it's net of, meaning without including CAM, without including real estate taxes or insurance. So that would be a triple net kind of way to look at that. But again, you're better off asking what's included in the rent as opposed to saying, oh, this is triple net, and getting all fancy with your terminology. Better to ask detailed questions. Ooh, mystery slide. Aha! A comparison of a gross lease to a net lease. So a gross lease for an office or a retail space might look and sound something like this, for example, right? And we quote commercial and industrial leases per square foot per year. That's the norm. If you're in a real small space, somebody might say, yeah, this office rents for $400 a month, but that's atypical. The typical lease is quoted per square foot per year. So a gross lease, if you call up an office building owner on the phone or broker on the phone and say, what does that place rent for? And they say $15 a square foot, and you know, then it would look like this. CAM, taxes, whatever else are included in that. But if you call around, you know, you're comparing spaces and you say, okay, they're $15 a foot, and you call someplace else and you say, what's the rent? And they say $10 a foot, that would also be accurate. Even if they also charge something for CAM and something for taxes above that, because those technically aren't rent. They're pass-through expenses that the tenant pays, all of which brings you, in this example that I, of course, crafted or created, the same $15 per square foot outcome. But if you stopped asking questions here as a broker investigating space and told your tenant, well, you know, the building on Main Street is $15 a square foot rent, and the building over on South North Street is $10 a square foot rent, you might be technically accurate, but you might also be incompetent because you'd be missing the rest of the equation. So you really need to understand what are all of the costs that the tenant will have to pay, and then you can figure out if you want to, you know, figure out is this a net or a gross kind of arrangement. For test question purposes, a net lease is one where the tenant is paying some of the landlord's operating expenses. That's kind of it. Or taxes maybe, if you want to look at that as something other than an operating expense, though it really is one of the main operating expenses. If you're a tenant, which scenario would you rather have? Same bottom line, in theory, which deal is better for the average tenant, do you think? Maybe this is, you know, this is hypothetical. There isn't an obvious right answer here. Why do you like gross? Why?
Because it's there for the entire length of the lease and it doesn't go up and fluctuate with the cost of the taxes.
So if we have a lot of snow, or if the property taxing authority gets greedy, you're not impacted. The landlord is, but you're not. You can bet that snow removal is a major part of CAM. I think we're paying, it's getting close to 20 grand a year now for the office building that I have in town here. That kind of would sort of ruin your home budget, wouldn't it, if you went home and said, honey, I'm going to contract with somebody next year to plow our driveway for $20,000. Don't worry, you know, they'll plow it all year for that. They better be there before it starts snowing. But, you know, for these kinds of properties, that's got to be there. So the more snow that falls, the more the tenant's going to end up paying, right? Because that cost has to be recovered. You get an early spring and a late fall and a lot of rain, you got to mow the lawn a few extra times, a little extra lawn mowing charge. Your neighbor, the guy who runs the pizza restaurant who just can't seem to throw away enough used pizza boxes, who fills up the dumpster every hour and a half, you're paying for a share of that here, right? Because CAM charges are going to cover the dumpster regardless of who's throwing stuff in there. So again, you know, it's much more predictable for a tenant over here. But if it doesn't snow next winter, or we have a drought or whatever, the tenants would save money. Every year, these costs are sort of auditable. A tenant has the right in their lease to ask, show me a copy of the real estate tax bill that shows the taxes went up 30% year over year.
Now, can the tenant benefit from the tax, can the tenant deduct the tax?
Well, keep in mind that a tenant's there in business, So every expense is a business expense. So rent is the same deduction as property taxes, right? It's a good question, it just doesn't matter in that case. Any other questions about the difference between gross and net? Yes, Steve, go ahead.
The square footage for the CAM and the real estate tax, is that something that's billed at the end of the year as to how much it costs? You give them an estimate as to what you think it may cost?
You bill monthly, so, just like you get a monthly invoice for your rent, that's all rent under a gross lease, you'll get an invoice here for the net amount that includes the expected amount of CAM and taxes, which are based upon last year's amount or this year's budget. And then when the bill actually comes due, that's when you should either give the tenant the credit or say, oopsie, you owe us X amounts of dollars and here's why. Again, tenants have the right to audit that. It's kind of a joke, really. I mean, I think it's kind of funny, but in every downtown high-rise in Chicago, I'm sure there's at least one accounting firm. Maybe, small CPA firm or whatever. So one of the things that accounting firm will do is send letters to every tenant in the building that says, don't forget you have the right to audit these expenses and you can hire us to do it for you. And we can say, pay us a few thousand and we can save you even more. I have to believe that every landlord downtown Chicago must think 2 or 3 times before they rent to another accounting firm in their building, which is just going to give rise to a whole other range of tenant audits. But you have that right. Occasionally a tenant will do an audit and find that even an honest landlord will make a mistake. For example, in the downtown high-rise area, you might have a property manager who gets a vehicle. They're getting a vehicle as part of their job as being the full-time property manager of that facility. Well, if that vehicle that the manager is driving from home to work, if the CAM only addresses the tenant paying for its use at the building, then the management firm or the employee needs to be paying for that truck from home to work and back, because that has nothing to do with operating the building. So why are the tenants paying for that portion of the expense? Those are the kinds of things that get turned up. Even when a landlord isn't intending to overbill, you get caught sometimes. You go, oh yeah, that's not in the definition of what we're supposed to be passing through. Many tenants will limit the management fees. They'll say, we'll only pay an X amount of our CAM can go towards the management fee, because they recognize that, like in my case, in many cases the landlord has its own management arm, or in my case, I am the management arm of the landlord. And so I have to watch that, because I might have my management fee limited, not by the investors, but by a tenant who would come in and sign up and not be willing to pay their full share of my management fee, which is part of CAM. And you say, well, why do the tenants pay your management fee? Well, they pay it on the gross lease too. You just don't spell it out and itemize it, right? It's all buried in there one way, shape, form, or another. Oh, which lease is better? Look at that. I suppose I should pay more attention to these clever things I do on these slides. Percentage leases, which you could get a math question at the state exam that asks you how to calculate one, aren't as common as the textbook might lead you to believe, or the provisions contained within them don't kick in as often as the textbook might lead you to believe. However, they do exist, and what the percentages are will tend to vary. If you have a percentage lease for a really big ticket item like a car dealer, for example, those are going to be a really low percentage, 1%, 0.5%, whatever, because those are big ticket numbers and the margins are small. But other kinds of things, the numbers might be fairly high, 10, 12, 14%. Restaurants and retail are where you see this kind of thing. Sometimes you can have trouble crafting this. So let's say that in our retail scenario, you got somebody like Sears, and Sears used to operate a really huge catalog business, right? Before they decided to kill off their catalog in the 70s or 80s, whenever they did that. How much of a store's catalog-related sales should be used to calculate the percentage rent? That's got to be ironed out. Sears has since gotten out of the catalog business, so they don't do as much, but now they have this thing called the internet. So how does that work exactly, right? So if I open a small store somewhere and I have a percentage lease and I'm doing $100,000 a month out of my store, and and that's not enough to trigger the percentage lease, what if I start packing things up and shipping them off to other parts of the world? What if I start, if I've also, as a hobby, have been, have some, an orchard and have fruit and maybe honeybees and whatever else, and I want to start selling that stuff through my shop, you know, if that's all being sold online and not through the store, is that or is not that included in the revenue that's used to calculate percentage lease? Something you gotta figure out. So anyway, that's just something you should be aware of doing the math. Basically, it's kind of what's the base, and is the tenant over and above that, and what's the percentage, and what applies. The only percentage leases I've ever entered into have never kicked in. The idea of a percentage lease is someplace like the Premium Outlet Mall, you know, the one that they're adding 60% to over there on Farnsworth by the tollway. That's ideal. A building like that makes everybody money. The landlord should be making a screaming amount of money on that place, and so should the tenants because of the huge volume of traffic. But the best way to share that is with a percentage lease arrangement. Tenants, retail tenants in particular, and maybe true for restaurants, you almost don't care what you pay in rent as long as the traffic in business will justify it, right? I mean, you know, the idea is to have a significant net profit at the end of the year or the end of the month or the end of the quarter or whatever. So you don't mind paying more in rent, and one way to make sure you don't pay too much in rent is pay a much lower base rent, but then offer the landlord something in a piece of the action. You know, but you can have 10% of all my sales over $3 million a year, or whatever it might be, so that it's worthwhile to the landlord as well. So again, that's just the basic idea. Now with apartment leases, if you sign a 1-year apartment lease for $1,000 a month, and at the end of that year you want to stay and you go to the landlord, what do you expect to have happen with that $1,000 a month rent? It's going to increase nominally, right? It's going to be $1,020 or $1,040 or $1,050 or whatever. It goes up. But when you have long-term leases that are 3, 5, 10, 20, 30 years, how do you deal with that? Well, there is such a thing called a flat lease. And I've known Walgreens to sign a number of these, for example, where the rent doesn't change for the entire 20 or 30-year period. As a landlord, I'm not a big fan of flat leases because what do costs generally do every year? They increase, right? And you're trying to recover those. Well, one of the advantages on a flat lease basis for the base rent in a net lease arrangement is if your CAM costs go up and if your taxes go up, those get passed through to the tenant, right? So you can have a flat base rent that never changes. And so, you know, the only real long-term variable then is the financing cost. But a couple of ways to do this are like through a variable lease to have adjustments. So a graduated lease is what I usually negotiate. So every year, you know, rent is just going to be something more. So fine, you're paying $1,000 a month for your space this year, Mr. Office Owner. Next year, you're going to pay $1,020 a month. In year 3 of the lease, it'll be $1,050. In year 4, it'll be $1,080. And in year 5, we're going to ratchet you up to $1,150. If you're amenable to that, that's what the rent's going to be. And that's the idea of it's graduated. It's predetermined. It's listed in the lease. And then on every anniversary period, you just start charging or billing for, and they start paying the higher rent. Kind of make a guess. I've seen leases graduated as much as 10% a year that ran for 10 years. At the end of that period, the tenant couldn't wait to get out of the space because their rent had gone up like 150% or something during the period. It was ridiculous how much higher it was because it's compounded. And then another way to do this is an index lease, where you just tie the rent every year to some index, like the Consumer Price Index. So CPI is an economic term that the federal government looks at, and it goes up or down, and it determines things like cost of living increases for Social Security and retirees and other things. You could tie the rent to that. So as the CPI goes up and down, your rent is going to go up and down every year. That's a way to do that. You can also have an appraisal lease, where an appraiser would look at it and appraise it every year. That's kind of a waste of money. But there's all different sorts of ways to make these long-term leases vary in a way that the parties can mutually agree. A ground lease is where you literally rent the dirt. So the closest ground lease that I know of for here, besides like a farm lease, where that's all you have, would be West Plaza in Aurora. I'm not sure about the Walmart, and I don't think the Lee's family owns all or much of West Plaza anymore, but where there used to be an Omni store and is now, the Hobby Lobby still there, Big Lots still there. I've been there for a while. One of them was thinking about moving, I think. But those couple of stores, that building was built by Dominic's, which is now owned by Safeway, which is soon to be purchased maybe by Jewel. It's all confusing. But anyway, Omni was a Dominic's subsidiary, and they built the building and they leased the dirt for 20 or 30 years. So that kind of a lease then makes the building, or excuse me, the property owner, they don't care what happens with it because the rent is due. You close your store, fine. We don't really care. Just keep writing us the check for the right to have it sitting there. So who then reconfigured it and put Hobby Lobby and Big Lots in there? Dominic's or Safeway did, because they had this building they've invested millions of dollars in, it was their money, on which, you know, they want to recover something, so they turned around and leased it. Not subleased it, because it was their building, then they leased their building to those other tenants. Another place where a ground lease was advertised for a long time was at the southeast corner of Randall and Main and Batavia, which is the northwest corner of Mooseheart. Right, Mooseheart needs cash, like any nonprofit. They own 1,200 acres of Batavia there. But they don't really want to sell off that land, because if they sell it off, they'll never get it back. You can't replace that kind of property around here in the future. It will just never be possible. So they wanted to raise a significant amount of money, so the idea was they would take that northwest corner of their property and do a 50-year term ground lease. Let a shopping center developer come in and develop 10, 20, 30, 40 acres, whatever, and just pay Mooseheart for the right to use the land for those years. And at the end of that 40 or 50 years, whatever was, or, you know, whatever the term was, that those buildings would either have to be torn down or they would revert to the owner of the land. And ground leases are fairly common. You have a lot of them downtown. I see a lot of ground leases for sale where you can literally just own the dirt under a McDonald's or under a bank or whatever. Very stable return on investment. You don't do anything with the building, you just own the dirt. Great way to leave land in your family for years with no property management headaches. Again, so it's fairly common, we just don't see it a lot in the suburbs. Not going to worry about oil and gas leases, you can kind of figure the basics out of that, I'm sure, for what you would need to know anyway. Lease purchase, which is also known as a rent to own, again, I'm not going to question you on that. It's an alternative to a land contract, it's a completely different arrangement. It's the idea where you have a lease and you simply have an option to buy. And so, or maybe $100 of your rent a month can count towards down payment or whatever. Again, land contract, you're making principal and interest payments. In a lease, you're just accumulating principal or paying rent. Sale and leaseback we talked about already in chapter 16. Again, it shows up here because that lease matters. It's not at all uncommon that in a sale and leaseback arrangement, sometimes the now tenant, former owner, will have the option to purchase the property back at some predetermined price, guaranteeing the buyer, the now landlord, some minimum 12, 14, 18% return a year, or whatever they needed to make that investment make sense in the first place. Not going to worry about agricultural leases. Again, I think it's pretty straightforward. Some stuff that really matters here is talking about breach. Again, questions for my final, for the state exam, and for practice, and these are also good things to know just as an individual. So a lease is a contract, a breach is a break, a contract is a series of promises. So breach of contract, breach of lease, broken promises, somebody's not doing what they're supposed to. So first we'll deal with the remedies given to the landlord. In other words, if the landlord is being damaged by the actions or inactions of the tenant. So here the tenant is in default. There's two types of default, just like with mortgages, financial or technical. So here under a financial default, the landlord has the right to give the tenant a 5-day notice, meaning a written notice, giving the tenant 5 days to cure the breach, meaning pay up the rent and late payment or whatever you owe. And then you're reinstated once the payment has been accepted. And it's important to understand here that even a partial acceptance of payment reinstates the lease as though it weren't in default, even though the tenant is still behind. So in the case of trying to go after a tenant, you give them this 5-day notice, and they don't pay you, you have the right, after that 5 days, to start the eviction proceedings. And what you do is you go to the circuit court here, he's talking about an Illinois example, you go to the circuit court, which is the court that's here in Kane County or in DuPage County or whatever, it's the county court, this is part of the state court system. And you go there, and in fact, you go to Chicago, they even have things like housing court in Chicago, Cook County, etc. Out here, you're just going to go and find the court where they're going to deal with this kind of thing, and you start that proceeding. Notice is sent, service notice is sent to the tenant, so they're served. They have 30 days right to know that when the date is to proceed, the tenant can show up and defend. They can hire an attorney. They can ignore it, do whatever. With residential properties in Chicago, some tenants are amazingly good at defending themselves, and they have found ways to stay in residential properties for months without actually having to pay rent because they just keep pleading their pathetic case to the court, who would rather not throw out a family or a whatever person, into the street, assuming that the landlord, can deal with it better. But if you're chasing that person, you would do the following. You file this forcible entry and detainer action in court. You have the 30 days, the summons, the service, basically the notice of the date, of the court date, and then, assuming you win a judgment at the first hearing, which you oftentimes do not, but if you do, you then go take that order of possession that the court will issue, and you have to take it to the county sheriff. That's the process. Now, going back to when you're still in the process of going through this actual eviction, you file a forcible entry and detainer. Say the tenant has been defending, they've been staving you off for months, and then they now owe you 5 months' rent. And as you're walking up the courthouse steps, about ready to go through the security process, they run up to you with enough cash to pay you 3 of the 5 months, or certified funds or whatever, and they say to you, here, take this, I'll have the rest of it for you next week. You have a decision to make. Because if you accept that partial payment, you've reinstated the lease, and you would have to go back and refile a new forcible entry and detainer action when they default again next month, or when they later owe you 6 months' rent instead. There was a case recently where a tenant mailed a check to their landlord for just a portion of the rent. They just mailed it to them, and then showed up a week later, or 2 weeks later, or 3 weeks later at the court case, whatever it was, and their defense was, Your Honor, we made a partial payment, and they accepted it. And the court would have ruled in their favor, except for one thing. The attorney representing the landlord opened the file folder and said, Your Honor, here is the check, and no, we do not accept it. And the court then ruled in favor of the landlord. But the tenant's whole case was predicated on, I'll make a partial payment, that'll have the landlord tempted to deposit it. Once they deposit it, I'm good for at least another month. Gotta know the game to figure out how to play it. All right, so 5-day notice, and any partial payment from the tenant that you accept reinstates them. Technical default, anything other than a financial default, you give them a 10-day notice to cure the breach. This could be in an apartment, somebody operating a business, too many adults living in the space, somebody renting a house from you, parking their car on the front lawn, a non-working or commercial vehicle in the driveway that's not supposed to be there. Anything that breaches the lease that's non-financial is considered a technical default. You give them 10 days to cure the breach. If they get rid of the car, throw out the in-laws, do whatever they need to do to get in compliance, you have the choice now, right? But you're probably going to, give them that 10 days. You're going to have to accept it. But after the 10 days, you have a complete choice. They can fix it, and you don't have to accept it. This deal up here with the financial, when they offer you money, when they tender you a payment and you accept it, that's an accord and satisfaction. That's a negotiation. That's bilateral, right? They offered you something, you took it. Down here, they offer you something after the 10 days. They throw out the in-laws, they get rid of the junk vehicle on the front lawn, whatever. You don't have to accept it. They might have done it. That's nice. You can pat them on the head and say, good boy, that was a good job. Still get your ass out of my apartment. Because you don't have to do the same thing here in the case of a technical default. You still have the right to force them out and proceed with the eviction process. Once you've got the judgment, the only people under our state law that can forcibly, physically evict people or their property is the sheriff. Now the sheriff can hire somebody else. The sheriff can hire off-duty deputies, they can hire a firm, but you can never lock somebody out or cut off their utilities or do anything else to them in this state when they are in breach of the lease until the court comes to you and says, here's the order of possession, take it to the sheriff, and the sheriff will go and supervise, and then you have possession. And that doesn't matter whether that's a technical default or financial, it doesn't matter whether it's residential or commercial or industrial. That's right. So legally, technically, there's this idea of self-help. There is no such self-help right when it comes to evicting tenants in Illinois. I don't know if any state offers a self-help right. It might, but Illinois certainly does not. All right, so tenants' remedies. We talked briefly about the warranty of implied habitability. Constructive eviction here is where the tenant can say to the landlord, you're in breach. The office space is moldy, or you just haven't done what you were supposed to do. You never built out. You said in the build-out letter, you said you were going to remodel this bathroom. You've never done it. You're in breach. We're giving you notice. We've been constructively evicted. We're going to move out. So the lease is over. The tenant leaves, and that's the end of it. Unless you're wrong. if what the landlord did would later get by a court not be construed to have risen to allow for constructive eviction, where the tenant was constructively evicted by the landlord's inaction, then the landlord's going to win and the tenant's going to be held to be responsible for all of the rent. I've been involved in a very hairy $1 million plus value constructive eviction case in the city many years ago, and it's very complicated stuff. So it's not, again, as simple as what I say here. They got in the landlord adequate opportunity, a reasonable opportunity to remedy whatever the problem is, and if they're still trying to fix it, or they're showing good faith in trying to fix it, you can't just move out and declare constructive eviction. You probably won't win that case. But if they don't, if they ignore you, say they're not going to do it, or just take way too long beyond reason, then maybe at that point in time you can do it. So this is a case, warranty of implied habitability is a better way to get out of a residential lease. This is better if you're talking about something other than residential stuff. We'll talk about this stuff in later chapters. We'll talk about this in a later chapter, and I don't know if that stuff's really important. So here's what we're going to do, because I'm kind of tired and I got to figure out what I'm doing for the next week and a half of my life. We'll pick up and we'll look at this when we get into chapter 18, either Thursday night or 2 weeks from tonight. Presumably, again, we'll have class Thursday night, and we'll just start off and we'll deal with this leasing commission stuff at the beginning of chapter 18. And I'll look at these other slides and see if there's anything else I want to talk to you about. But I do want to give you a sense of the kinds of dollars involved that are available to brokers who make a living doing commercial and industrial leasing. Because it is an option for some people as a way to make a living. And since I have had the opportunity to participate in that world a little bit, I'll share that with you so you can have a sense of what that might look like as compared to the commissions you get from selling houses and how it would work and that kind of thing. All right, so if you have any questions, please feel free to hang out. Otherwise, I will see you presumably in 2 nights. Again, just keep an eye on your answering machine or your voicemail or whatever on Thursday in case I'm not able to make it.